We have seen a lot of movement in the markets this week in the semiconductors off of news out of China that the restrictions would ease somewhat for U.S. suppliers to Huawei and what that indicates. We saw a big rush from the chip makers and then some pulling back. Tell me what's happening in this sector.
Well, it's one of the things that we have to worry about right now with this big move in the stock market because, of course, the semiconductors have been an incredibly good leadership group. They warned us about the fourth quarter deep correction when they rolled over early, and then they led the market higher in the first half of the year. The thing with Huawei, though, however, is that we were already seeing some weakening in the sector in terms of orders, sales, et cetera, before the restrictions on Huawei came about and before we had the trade talks break down at the beginning of May. So they were already seeing a little bit of weakness. And then now we have this confusion over, are the restrictions on Huawei being lifted? Are they not being lifted? Are they only being lifted by a little bit? Nobody seems to be entirely sure. And now it seems to be like there's going to be a less of a positive move on the group. And, as you mentioned, they've come back down. I mean, they've retraced about 75, 80% of the big pop they saw on Monday. So if this group rolls back over, it's going to be a problem, not just for the semiconductors as a group, but I think for the broad market overall because of the leadership they've provided.
All right. So a lot of this is what we're going to see coming up this year may hinge on whether the Fed cuts rates. We had Peter Navarro on CNBC yesterday saying that he expects that the Dow Jones would very soon hit 30,000 if the Fed cuts rates and if the trade deal with Mexico and Canada were passed by Congress, confirmed by Congress. What's your feeling here about a Fed rate cut and how much it would move the market?
Well, it's one thing. Peter Navarro, obviously, he's going to talk bullish about the stock market being inside the White House. However, he also called for 25,000 on the Dow when nobody thought it was possible back when Trump was elected. So I don't want to poo-poo his comments completely. However, the one thing about that people think are a little bit making a mistake here about the Federal Reserve. They say, hey, every time in the last 10 years the Fed has been accommodative, made an accommodative move. That has really helped the stock market pop immediately. The problem is each one of those times has been a QE, a quantitative easing move, which has added liquidity directly to the system immediately. And the Fed, people forget, the Fed hasn't lowered rates since 2008, and that has a much bigger lag time. It doesn't have immediate impact on the economy, doesn't have an immediate impact on the markets. So people relying on the Fed to really juice the market after it's already had a big run is a mistake. Now, don't get me wrong. Fed accommodation is hopefully will buoy the market, but when it's rate cuts rather than QE, it doesn't have that direct impact that people, I think, are relying on.
If you think investors are putting the cart before the horse where Fed cuts are concerned, how are you feeling about earnings season?
Well, that's going to be the big thing. Right now, people are talking about if you're relying on the Fed, you're basically relying on multiple expansion. But how much multiple expansion can you get if earnings are really going to be disappointing? Now, obviously, every time we come into earnings season, they lower them enough so that they can be beaten. So we beat, they're going to beat expectations. They always do. So they'll be okay. However, what is the forward guidance? We always care about forward guidance, even more so this time around, especially not just third quarter guidance, but fourth quarter guidance, because we've been relying all year long on good, solid earnings growth for the year because we have a big pickup in the fourth quarter. However, that has gone from, for the fourth quarter, estimates have gone from 11% all the way down. It's now below 7% for that quarter. And if we don't get that big pickup in the fourth quarter, the earnings forecasts, which are still for the full year at only at 2.8%, are going to come down even more. That's going to make it tougher for the stock market to rally further. Again, I don't want to sound overly bearish here, but there's some concerns.
There is a bearish outlook right now for oil, down 4% yesterday. What's driving the declines here?
Yeah, that's really, it's one thing when it first started going down, I thought, oh, it's just kind of a buy the rumor, sell the news kind of situation. But that would only account for maybe a 1% pullback. You get oil dropping 4%, there's something more to it. And, when you see, the big concern, of course, is demand. Global demand has been coming down all year. Does it show that the global economy is weakening further? And, of course, you look at the low yields around the world and in the U.S., you mentioned at the top of the show, where the U.S. rates have fallen back below 2%. When you have a combination of oil prices coming down, interest rates coming down, it kind of shows you that the look for pickup in the economy in the second half is falling by the wayside, especially now. I think a lot of people are saying, hey, this trade truce is great, but we're not going to get an agreement for quite some time.